I start recording.
Okay, so I guess let's start. Hi everyone, welcome to today's Accounting Design Project virtual event. I'm Chen Qizhi, Assistant Professor of Accounting at UC Irvine. So it's my great honor to kind of moderate today's event and as a NYU graduate. So it's really a great honor. So our today's speaker is Joshua Livnat, and he is a professor of emeritus at NYU Stern. So he will tell us about analyst strong views and market reactions. Just very quick. I guess you guys probably already know the drill, but very quickly the housekeeping items. Please mute yourself to avoid some background noise. And if you have any questions, you can just speak up, or you can raise hand, type in the chat box. I will monitor both. And Joshua, you have the first 5 minutes uninterrupted, and in the last 5 minutes, I will give you a reminder. So the floor is yours.
Thank you so much. So this is joint work with Dan Siegel, who was at NYU, and then moved to Toronto, then back to Israel at Reichman University. And he also is affiliated with the University of Warwick. And a PhD student there, Ziki Tang, whom I've never met. I've never been to Warwick, don't know what it's like, but we work well together. So let me just provide a little bit of why do we do what we do. So typically an analyst would cover about 15 to 17 stocks. And the question that we asked ourselves, when an analyst covers 15 stocks, does the analyst have any stronger views, both positive or negative, about the firms that, or some firms that they cover? And why would that be? So one of the things that could affect it is because the analyst has some inside information or better knowledge about a particular industry or particular companies. The analyst may have closer ties to management, or because of the brokerage firm that they are employed or other reasons, they are motivated to invest more resources into following specific companies. So we tend to, our null hypothesis, if you want, was that analysts have some ways or some inclinations to feel stronger about certain companies in their covered portfolio. Now, I want to provide a little bit of background just to explain that a little bit. So there was a very famous case, it was called the Goldman Sachs huddle, where what happened was analysts would come up in the morning call and would share information about what they were going to do in terms of their reports, whether they were going to issue a strong buy or have some kind of recommendations or earnings, and shared it with Goldman's own traders. And those traders also contacted other people on the buy side, and people used the information that was not in the public domain. Goldman was fined about $10 million on it. Also, there is a group called TIM, and what they do is provide information to the buy side about analysts or other people's strong trades. And the idea is that they get compensated for it, and the people who come up with those ideas get also compensated by TIM. So you have the buy side purchasing information or trying actively to find the information about which of the companies that an analyst follows are companies with strong views. Now, we were really heartened to see a paper by Biru et al., which was published in the Review of Financial Studies, where they actually found companies which the analyst designated as a top pick or best ideas. And they showed that you could get abnormal returns if you trade on these companies. So what are the research questions that we want to explore? So the first research question is when analysts come up with announcements about target prices, that's what we do in the paper, do analyst revisions of target prices, are they stronger if the analyst had strong views about the firms as compared to his or her other covered firms in their universe? And second question is, can investors use this information in order to construct portfolios that would have abnormal returns? So what was the methodology that we used? We used the target price ratio. So the target price is one of the elements that an analyst usually comes up with. And that is typically what would the stock price be in the next 12 months. So this would be the target price. We look at the target price ratio, the 12-month hence price to current price. And this, in a sense, is the analyst expected rate of return. So we use that in order to assess what is the analyst's strong views. Is it is the company that they just released a target price for, is that on their good side, i.e., the highest target price ratios, or is it on their bad side, the lowest target price ratios? And then what we do is assess the immediate and drift returns of target price revisions. What do we find? We find that indeed there are stronger market reactions to target price revisions where the analyst has strong views, both positive and negative. And we also found that if you combine all these strong views of companies by different analysts, then you could earn a significant abnormal return. So that's an overview of the study. And I guess my 5 minutes are up and people can start asking questions.
So I have a quick question, and others can ask a question. So please forgive my ignorance about this literature. So why, like, the goal is to kind of measure one of the goals is to measure the strong views. Why do you use the target price instead of earnings, EPS forecast versus stock recommendations? Like, what's so can you tell us more about what's so unique about the target price ratio?
Yeah, so we explain it a little later, but I'll give you a forward to that succinctly, and we'll cut it later on. So recommendations, when people come up with recommendations, analysts come up with recommendations, they usually have either a three-level scale, or a five-level scale. And what you see is that they don't distinguish among the people that, or among the companies that they give high, let's say, recommendation for. So you don't know if they have high recommendation for 7 stocks, you don't know which of the 7 is their best company. It's indistinguishable. Analysts also don't give typically sell recommendations. Very few get sell recommendations. And also recommendations don't change very frequently. The typical recommendation is revised only about after about 3/4 of a year, and about 25% of all recommendations don't get revised at all during the year. So not many changes in recommendations, and that's why we felt we need a better measure. Second, target price is a continuous measure. So it gives you a better measure of, if you want, expected rate of return, which is what investors are actually more interested in. So that's about recommendations. Why didn't we use earnings forecast? The answer to that is that if we wanted to use earnings forecast, you needed to have some kind of a scale to assess whether the analyst has strong views about the particular company. And then you needed to use something like an earnings to price ratio or something of that nature. And we know that companies, even in the same broad industry, may be very different. So in the healthcare sector, for example, you have companies that are medical devices, companies that do healthcare, providers, and companies that are in the biotech area. And they have totally different growth rates and risk parameters, etc. And coming up with a good measure to standardize was difficult. So we felt that the more natural thing to do was to use the target price.
Paul, you have a question, right?
Yeah, I had two questions. So one, Josh, so the strong view is measured by the expected rate of return, right? Is that basically those synonyms? Okay.
Yes.
So what happens if different analysts have different, some say, oh, I think it's going to double in price next year. Other one says, oh, I think it's already, what happens in that disagreement case?
Yeah, so we do two things in the paper. The first thing that we do is we ask ourselves, does the market react more strongly when the target price revision reflects strong views? And we answer yes, it does. And then what we do is we take a lot of analyst views of the particular company and aggregate it. So think about it as a consensus view. And it's true that some analysts may think this is the best thing that happened, and some others do not think that way. But the question is, can you aggregate it and get a meaningful signal for trading? And the answer is yes.
Okay, one last question. That makes sense. Does it matter what the reason is if they say, there's been a new discovery or revenues are expected to be stronger? Does it matter, kind of getting under the hood what the reason is, or just the fact that the consensus expected rate of return is 20%?
Yeah, so we did not go and look for reasons. We looked for something that would be applied consistently across many companies, and that's what we chose. But is there a way to improve? Probably. If you go and read the reports and try to dig from that, but we have not done that. Any other questions, comments?
We are good for now.
Thank you. So just to highlight, and this is not ours, it's actually from Bradshaw at 2009. So analysts typically come up with, look at financial and non-financial information, then they come up with an earnings forecast. Based upon some kind of a multiple, they determine the target price that the company should have. And based upon the target price relative to the current market price, they have an expected return. And according to that, they come up with a stock recommendation. And brokerage houses have all kind of parameters in place. So for example, they may say you are allowed to come up with a strong buy recommendation only if you think that the stock performance is going to be 20% and or in the top quintile of the industry, or all kind of measures of this nature. But the idea is that target price is sort of in between the stock recommendation and the earnings forecast. Are the three integrated well? So we know that, again, from the literature and anecdotal evidence, that brokerage houses would have typically a compliance unit. And if you came up with a stock recommendation that did not reflect the return that you should have, they may ask you, why did you do that? And may actually ask you to either revise the forecast or change the target price or change the recommendation. So supposedly there is some there are some guidelines in-house that drive it, but we know it's never perfect. So what do we know? So just a little bit of institutional background. We know that analysts predict annual and quarterly earnings per share, a lot of other items as well. Typically, revisions of earnings, annual earnings, occur within 7 days of the preliminary earnings announcement. That's something that we documented in prior studies. We know that after an announcement of an earnings revision, there is typically an immediate market reaction and a drift as well. We know that earnings forecast revisions are used by many quants as a growth or momentum measure. So typically what quants do is they look at the number of positive minus the number of negative revisions divided by total revisions or divided by some other measure. And that is an indication of our analysts being more optimistic about the firm or more pessimistic. As I mentioned earlier, we decided not to use earnings forecast because of the heterogeneity and different accounting measures. So we felt that this was not an ideal way to actually look at companies. What about stock recommendations? As I mentioned, they have their own issues, and I'm not going to read you what I said earlier. We decided to use target prices. Now, target prices, we know that about 35% of all target prices are revised within 7 days of the earnings announcement, preliminary earnings announcement. In terms of revisions of target prices, they occur about 1/3 as often as for earnings forecast revisions, as compared to only 1/10 of recommendations. Another reason for using target prices. And prior studies found out that there are market reactions to target price revisions, and this is the basis for what we want to study here. Now, what was really good for us, although we discovered it after we've done our study, is this paper at RFS, which essentially what they did was they went and identified from analyst reports, those reports where the analyst actually said top pick or best idea. So the analyst designated these companies as their strongest companies.
Joshua, Ayun has a question.
Sure.
Mm-hmm.
Joshua, my question relates to the previous slide. So I think it's interesting to know that the target price revisions actually has incremental information. Can you kind of share with us a little bit more about those multiples analysts use? Are more kind of like industry multiples, or how much is actually analyst-specific adjustment from the earnings forecast to the target price? Like what actually go into between those two steps?
Yeah, I cannot share with you because I don't know. We don't know how analysts come up with these target prices.
Okay.
The model that I presented was not ours, it's Bradshaw, and
Okay.
it's reasonable, but what do they actually use? Do they use industry-wide? Do they use their own multiples? We have no idea. By the way, one of the things that we are in the process of doing is trying to come up with another measure of strong views, which would be based upon using multiples and the earnings forecast to see if we have the similar results. So we are doing that. But
the reason I ask that is that in a typical financial statement analysis class, we have a lot to tell our students about how to forecast cash flow or earnings. But when we forecast discount rate, that is something is a black box that we don't really able to provide much guidance. So like that's what I'm curious. From earnings forecast to target price, the missing part is the discount rate. And it seems that there's some evidence that's showing their incremental information. So I'm just very curious about their efforts to estimate that discount rate for that firm at that particular time.
yeah. So I'm sorry, but our paper does not shed any light on that.
Jing has a question.
Oh, hi, Joshua. This is just a follow-up of Ayang's question. I think our view that it's the P ratio that kind of multiple apply to earnings. In Brown et al. Paper, the survey paper of sell-side analysts, they actually say it's like they get the earnings estimates and then apply the P ratio. But as Joshua mentioned, they didn't disclose too much about whether the P ratio is per firm, industry, or others. So I think, Joshua, your following analysis about separating the target price into the earnings part as well as the ratio part can be very, very valuable. I have a related question or reason to just promote this test is because when I heard the target price based measure of the extreme news, I thought of the bold forecast literature of analysts, right? So the earnings, I mean, bold forecast and their extreme, like, or more upside target price, they are like related. So if you separate the target price into the two parts and show some part is the multiple part, it's so it by itself shows the difference or distinction from the large bold forecast literature.
Yeah, so the approach that we took is slightly different. I mean, it's related, but what we did was we computed an industry-wide across all analysts multiple and used that. We came up with the multiple for the analyst covered universe. So an analyst who follows 15 stocks, what was the average or the median PE ratios that they have? And we also did that for the analyst in the particular industry. So we have 3 measures of multiples, and then we asked ourselves, does the target price reflect it? Is it above it or below it, in order to identify the strong views? So that was the alternative approach that we took, but it's not currently in the paper. We're still working on the details.
Thanks.
Any other questions, comments before I move on? Okay, so I mentioned the Biru et al. Paper. effort that they took was immense in terms of identifying actual designations. They found about 3,500 such designations over a 17-year period. And we felt that was a little too low. The other problem that they have is they did not actually identify any worst picks. I mean, these are only top ideas or top picks of companies. And therefore, they had a sparse universe, whereas in our approach, we can actually identify both sides and we can identify much larger universe. Okay, what else do we know about target prices before we continue? There is a recent literature that looked at target prices, and people found out, not surprisingly, that target prices, analysts tend to be too optimistic, and it may be related to forecast errors or forecast risk, as Jung mentioned earlier. It could be due to earnings forecasts that are erroneous, or because they have job-related incentives. Since a lot of you are going to be teaching this type of material, so I'll share an anecdote from my days where I was teaching an e-commerce class, e-commerce valuation class, and brought in an analyst. The company that he looked at had a target price of about $30-some, and the company was trading at that point at around $7 per share. And the MBA students, of course, are pretty blunt, and one of them raises his hand and he says, "Can you explain the difference between the two?" Or asked it, I think, in a less, "Are you sure about your target price?" And the analyst smiles and says, "Look, our firm took the company out public, and we took it out at $30 per share. So, of course, my target price has to be a little over that." So are there job-related incentives? Yes, there are. And those could affect the target prices. There is a management science paper, which we quote in the paper, that actually looks at that and finds out that this is not what causes target prices to be overly optimistic, but it's there. We are not interested in the accuracy of the target price. We only use it as a mechanism in order to identify the strong views, both positive and negative. How do we do that? So the first thing that we do is we look at the target price of the analyst when the analyst revised the forecast and compare it to the price the day before. So that gives us an expected return for the particular stock. We do the same for all the other companies that are covered by the same analyst. So if the analyst covers 14 other firms, we look at each of these 14 firms, get the most recent target price for each of these firms, and divide that target price by the closing price for the stock the day before. Okay, so we have, in a sense, a modified target price, modified or updated for each of the covered companies by the analyst. So now we can compare them on an equal footing, and then what we do is we rank them into quintiles and essentially say the top quintile with the strongest or the highest target price ratios, the highest expected returns, would be the companies that the analyst feels most strongly about. And conversely, the bottom quintile would be the companies that the analyst feels the least optimistic about. So that would be our negative views.
Young has a question. Yeah.
Hi, Joshua. I have a question about this measure. So I like the measure is kind of a controlling for individual analyst optimism, right? If this person always are very optimistic, you kind of like try to rank within this individual to find a top pick. But relatedly, I wonder whether an analyst portfolio will have companies from very different industries or business models. Because previously you talk about that potentially multiples would not be equal across firms. They are from different business industries, etc. So are you picking up potentially just some industries has a higher expected return compared to other industries when more heterogeneous portfolios is held by an analyst?
Right. So the common wisdom is actually that analysts cover only one industry, which is wrong because we found out that about 75% of our of analysts that we have in our sample cover more than one industry. But the industries may not be very different from each other. We use the 48 industries of pharma and French to do that. And it may be related. And it may be in the same sector, but not that very different. Is it an issue of multiple that is different? Could be, but supposedly that should have been also factored in the current market price. So when you look at the target price to the market price, you get essentially the expected return. And that's what we are trying to capture.
Thank you.
Paul has the next question.
Yeah, Josh, so the fact that the market would respond when the analysts say, you know, the expected rate of return, how you measure it is, you know, very high or relatively higher than other companies. That's not surprising to me because the market could, you know, view the analysts as these guys put in, you know, so much time and effort. Well, I wouldn't call it quote unquote inside information, but it's the product of their analysis. So that would make perfect sense to me. But what surprises me is that the market would not immediately impound that that information. Okay, so I mean, to me, it looks a lot like the post-earnings announcement drift. Okay, so I mean, am I in the wrong place, or is it similar to that, or?
Yeah. So, is your question about whether the market is fully efficient?
Well, sort of. I mean, because it seems like
I'm just pulling your leg a little. Paul and I had these discussions many times in the past. Yeah, so the answer is probably, yeah, there would be some people who would react immediately. Now, in the paper, we provide try to provide some logic to why there would be also a delayed market reaction. And the logic goes as follows. If you know what analysts are doing, analysts not only coming up with their forecast or reports about companies, but they also go and speak to the buy side and try to interest them in what they do. Now, if you have a meeting with the buy side and you have, let's say, 15 minutes or 20 minutes to present, which companies are you going to present? You're going to present your best ideas or your strongest views. And when you do that, that would get some reaction among the institutional investors. And then supposedly the institutional investors trade on it. And once they trade, there is a market reaction, which because of momentum can instigate retail clients or small investors to react as well. And we show in the paper evidence, we provide evidence that companies where analysts have stronger views actually have also more managers, money managers who pile into the stock, and also have higher institutional holdings. So there is a little bit of evidence of that happening. But at the end of the day, who knows, right? When right now I'm recorded, so I'm not going to provide all the information, but if you want to get a little bit of stuff that I do not want to say publicly, I would do that later on. Okay? Okay, so we do that at the time of the analyst revision of target prices, but we also do that on a monthly basis when we form our portfolios, and we do that also annually. And the way we do it is we look at the month end, identify all the companies, all the analysts that covering a particular firm. For each of those analysts, we go and calculate an updated target price ratio as of month end. So here we take the most recent target price ratio for each of the companies that the analyst covers, and then use the month end or the day before price in order to calculate the updated target price ratio, compare them, and rank them into quintiles the way we did before, and then average those quintile ranks across all analysts. Once we do that, we can re-rank all the firms into quintiles based upon the sort of consensus or average target price ratio rank. And that gives us an idea about are most analysts really optimistic about this firm or pessimistic about the firm. And we do the same thing on an annual basis for some of the tests before. Questions? No. Okay, I explained the issue of buy-side analyst and why we expect a drift before, so I'm going to skip that. We spoke about the research questions. So what are the sources? So we use IBEST as a basis for target price ratios, etc. And we use CRISP for returns, CompuStat for some of the measures. The sample period is 2000 to 2023. Why 2000? Because target prices were not available before 1999 in the IBEST database. We also wanted to make sure that we have good representation. So in order to rank an analyst with, or all the companies that an analyst covers, we require that the analyst would have at least, excuse me, at least 5 firms for which the analyst issued a target price within the last year. And each firm had to be covered by at least 3 analysts in order to later on combine it into sort of a consensus forecast. So what do we typically have? We know that target prices are typically revised upwards, not downwards. We know that the firms that we would have, because they are followed by analysts, by many analysts, etc., would be larger than the typical CRISP universe. And we also found out that the sample leans slightly towards growth firms. And again, that makes sense. If you think about if the strong views are those that analysts are really gung-ho about, they typically would be companies where the market does not realize that the potential, and there is a little bit of growth element in it. Just to give some kind of idea, so in The average target price ratio is about 20.7. That's the highlighted first number, higher than the current market price. So the analyst expects a 20% return. Now, think about it logically. What would you expect the market to do on a typical year? 20%? Maybe not so much, right? But that's what the data shows. And it's really consistent with a lot of studies that looked at target price ratios being overly optimistic. What other interesting information? We know that on average, target price are revised about 109 days apart, or about 3 months at the median. And in terms of how frequently after earnings do analysts revise their target price, the mean is 30, as I mentioned before. About 35 of them, or about 1/3, get revised within 7 days of the earnings announcement. We can, if we look at market value of this firm, so the median firm is about $2 billion, which is way above the CRISP database. So this is, again, larger companies. And by the way, with larger companies, you don't expect to see abnormal returns in a study. And the fact that we see, that's actually nice. In terms of the other measures, growth and R&D intensity and book to market, those indicate a little bit tilt, or a small tilt, towards growth companies. Okay, so let's look at the target price revisions. And we know from the literature, and this is a base case. So what we wanted to do was to try to find out what are the determinants of target price revisions. And the first thing that comes out is the return from the previous period. So what we did here was we looked at the target price today, target price before, which is on the average 90 days or so before. And during that period, what was the return on the particular stock? If the price moved up, typically the analyst would revise it, would revise also the target price upwards. Also, it's related to the earnings surprise. So if there was a positive earnings surprise, the analyst would have increased the target price. So that is just to see what are the main effects for, or the main drivers of target price revisions. Now, what we did then was to look at what is the effect or the market reactions to the target price. So we have here 3 different periods. The first period is the -1 to +1. So this is the contemporaneous return. And you could see that the contemporaneous return is positively and significantly related to the target price revision. So if the analyst revised upwards, typically upward the stock return, and same or converse for a negative revision. It's also related to the SU rank and the return, and we needed to control for those, given what we know about the influence of those on the revision. We also look to see what would be the effect on the 30 days after the announcement, 60 days and 90 days. And we can see that all of them are positively related to the target price revision. So again, this is to verify base case, to verify that what the literature has found earlier, that target price revision drive prices both immediately and in terms of drift. Now, what we did was we said, okay, let's look at it relative to the target price revision rank. So the target price rank of the companies where the analyst feels the most negative about, the lowest target price compared to the analyst's own covered universe. The target price ratio there was only about 1.6% above current market price, where the analysts feel more strongly about, they had about 43% expected rate of return. Now, if we look to see what was the target price revision, of course, no surprise, it was in the same direction, monotonically increasing. But what is nice is that when we look at the abnormal return are also in the same direction. So where the analyst feels the most negative about, negative market reaction immediately. When the analyst feels strongly about, positive market reaction. And the same thing we can see for the abnormal return in the following periods. We try to see what it's related to, and that's in the panel B. I'm going to skip on that, less important for those of you who want to find out. We try to see if it's related to other things, and we couldn't find out any particular differences except what I mentioned earlier about being a little more growth in the stronger analyst views.
Paul has a question.
Yeah.
Yes, so this is a market response to the target price announcement. When in relation to that announcement does the earnings get announced?
So we mentioned that for about 1/3 of our sample, earnings were announced in the prior 7 days.
Prior to the announcement.
Prior to the target price revision.
And the reason I'm asking that question is, so the remaining 2/3 are on or after, correct?
No, so yeah, after I would say.
So, we have a lot of evidence the market responds to the earnings announcement. So if you take out that day or those 2 days, how much are you left with?
So what we did was we actually conducted the study separately for the 2/3 that were not at the same time or closer, excuse me, closer to the earnings announcement, and we found out that the relationship holds equally for both samples. So for the sample where it's close to earnings, you could say that the market reacts to the earnings announcement. But you cannot say that for the other companies.
One more question. So what you said before about the brokerage firm gives the information to their big clients, right? And then they trade, and then it kind of goes down the chain, so to speak.
Yeah.
Okay. I assume this is all legal, so
once the analyst publishes his or her report, I think it's public information.
Even if it's only given to a select group of the biggest clients?
No, as long as the analyst provided it publicly, said, my recommendation is such, or issued the report, and anybody who wants to buy the report could get access to it, I don't think there is a legal issue for the analyst to talk about it publicly and get buy-side clients to react to it.
Because this makes a lot of sense. You got this chain going down, and while I wouldn't call it inside information, let's call it privileged information that's kind of going down the chain. And aren't technically a lot of the regs like Sarbanes-Oxley kind of designed to make a level playing field, so to speak? And this sounds kind of not really like a level playing field to me.
So again, if you ask me what happens in practice, the analyst who wrote the report, which is public, Anybody can get that, maybe for a fee, but everybody can get it. But then the analyst meets the buy-side investors, and the buy-side investors would try to dig into it and ask the analyst more questions. Why did you do that, etc.? And then they may talk about things that are not directly, let's call it public, and more strategic in nature, etc. And I know that, in fact, that happened. So you get sort of color in addition to the just numbers.
So, in terms of how this is playing down, kind of like well, I'll use the word mechanism. That's a big word these days. Can you document at all that after the target price announcement, there's excess trading by certain investors, whatever these big funds are, or is that information just not available?
So
that would help
we,
kind of
yeah.
back up the story you're telling.
Yes. So what we did was we said, let's suppose there was a target price revision, which was very positive today. We look to see whether in the following quarter, institutional investors increased their holdings or if more managers joined in. And the reason we went for the following quarter is because the information about that is only quarterly. So we couldn't find out immediate trading.
But you find evidence for that kind of sequential story that you were telling?
Yes, yes.
To me, that's the most interesting. I have to be honest, that's the most interesting thing, is that you have, what's really going on under the hood, so to speak. Why is it taking time for the market to incorporate that target price? And it makes a lot of sense what you're saying. It goes to the big guys first, and then the medium-sized guys, and then the little guys. And whether the regulators want to do something about that, is their choice. But it makes a lot of sense why the information would kind of seep in to price.
That's what we tried to show in the paper. But we didn't look at actual trading of institutional investors in the sense of immediate market reaction. We didn't have that. Any other questions? Okay, so then what we did was to look at the target price rank, and we see that if we look at the interaction is always positive and significant, which means that the stronger the views, the larger is the market reaction. We also split it into those that had the highest target price revision, or I'm sorry, not highest conviction, and we found out that for them there was a positive relationship. If we went to the ones where they had the lowest expectations or the lowest expected returns, there was a negative market reaction, which is what you would expect. Then what we did was we looked at changes in the target price rank from the previous target price, and we found that that is also positive. So again, all this evidence shows that the market at least can sense or can assess the target price revisions that have stronger views by each analyst. Again, it needs a little bit of mechanics to do that, because you need to always keep track of which stocks are in the covered universe of the analyst, compare it to the past, as we did, but you could actually find out that the market sees through that. Now, can you do that and get abnormal returns? So here, what we did was we combined it across all the companies and across all the analysts, and found out that, if you look at the companies where analysts were the least optimistic, the abnormal return was negative. where they were the most optimistic as a group, the abnormal return was positive. Abnormal return in the following month. So that gives us a little bit of, if you want, market reaction that you could get, or market, if you want, abnormal return that you could get from trading on this strategy.
Could I ask a question?
Please.
Yeah, of course, abnormal returns are everywhere and always present. I was wondering if you're trying to assess your abnormal returns relative to the 200 other pre-existing anomalies. In other words, how do they compare with other well-known anomalies? Are they distinctly better or about average, or in some sense worse from what you see generally? Is my question clear?
Yes, it's absolutely clear.
Thank you.
Let me try to dodge the question like a lot of politicians would do. And
academics too.
Yeah, well, so we have not assessed it directly, but I'll tell you what I like about our results. First of all, we are talking about the larger stocks in the universe, right? Those that are covered by many analysts, etc. The second thing that I can tell you is that most of the abnormal return that we get is actually from the positive side, which is fairly easy to trade. And since these are large companies, I know that it covers easily the transaction cost. Does that make sense, Jim?
Yeah, no, fair enough. All I'm saying is it would be nice if you could quantify and compare to other anomalies. In other words, on annual returns, most people know that any abnormal return, which is 5% or less, can easily be neglected. There's a literature on why you should neglect abnormal returns. So basically, the question is here, are we seeing what you expect to see, even though as a first cut, the market is efficient? Another possibility is that you have something here that's very distinct. And there's every reason compared to the aggregate experience to believe that these are exploitable. We don't know who can exploit it, but it would be nice to know that if you just look at the numbers, you could say, relax, I think these things are exploitable. So that's sort of a curiosity for many of us.
Okay, so I can tell you that this is exploitable.
Oh, okay.
Sorry to cut into the discussion. We have 3 minutes left.
Yeah, so Jim, if you stay on for when we are not getting recorded, I can tell you why I think it's exploitable.
No, it's fair enough. I mean, I'm just curious how you see it. Yeah.
Yeah, it is exploitable.
Yeah, in other words, basically, I mean, again, then I'm going to be quiet. There are claims that you have abnormal earnings. Nowadays, people demand more.
Yes. Yes, I fully agree. Now, these are monthly returns. So 1.4% of raw returns, I think it's pretty good. And remember, this is the largest companies.
Yeah, fair enough. Yeah.
Okay. As I mentioned, most of the gains come from the long part, etc. We did Fama and I'm sorry, Jensen's alpha to see whether that happens. And as you could see, mostly it's in the high-ranked securities, but it's negative for the low-ranked. And again, I'm sorry, it's you could see that most of the action comes from the high rank and pretty significant. It's monthly 1.2%. Mentioned about the institutional investors. I'm going to skip that. We also, and that's something that I always believed you should also do, is look to see what are analysts actually able to identify companies that are better. Because if you believe in strong views, That is what they should do. So what we find is that the changes in cash flows the year afterwards, 2 years afterwards, 3 years afterwards, are positively related to the rank. So analysts are actually able to find companies where the changes in the fundamentals of the companies are higher. So that was another dimension that we wanted. We did some robustness tests. I'm not going to talk about it. And I think that concludes the study. I want to thank you for your time, attention, and Chen Qi, you want to talk about the next presentation.
Yeah. So thank you, Joshua, for the great presentation. I learned a lot. So before you leave, one more last takeaway for you. So we have another interesting paper in 2 weeks on Tuesday, March 4th, to the same time, 12:30 to 1:30 Eastern time. It's presented by David Wingman from University of Amsterdam, and the paper is about seasonal variation in cash flows and timing role of accruals. So you can register in the usual way. I guess you guys also got the email alerts.
Thank you.
Thanks. Great seeing you, Josh.